All right, so thank you for inviting me. This is joint work with Woo-Chan Kim, who's in the audience, Vic Khanna, Gledson Di Carvalho, and Berchan Yurtoglu. And we're going to be looking at emerging markets, right? We don't care about the US and the UK. And we're going to be looking at firm-level governance within the range that firms are permitted to choose in any particular country. Every country has some legal minimums, and we're looking at the effect of changes in firm governance on Tobin's Q as a traditional, if imperfect, measure of firm value. It's not a causal design. If you belong to the endogeneity police, you can leave now. Our view is we're going to do the best we can with a non-causal design and try to persuade you that the results are plausibly causal, and it would take an awful lot of omitted variable bias to overturn the main results. Okay, so we have a prior paper that looks at overall corporate governance indices, where we argue, I believe this is correct, that if you want to have an index that actually predicts anything, you better build it on a country-specific basis, taking into account country legal rules, country institutions. I'll give you some examples of why that is. We're going to take those indices, and instead of looking at the whole index and whether it can predict Tobin's Q, say, okay, let's break it down into disclosure, board structure, board procedure, control of related party transactions, and see which of those sub-pieces seem to predict firm value, and I'll show you some results on which do and which do not. And then we can talk about, to the extent we find that we don't have predictive value, is that because this aspect of governance isn't important, or just because we haven't done a very good job of measuring it, right? There's always the question of what are you actually measuring? We don't know what good corporate governance is anyway. So current project, prior project, again, we're focusing on emerging markets. We're not doing the LLSV stuff. Do country-level rules affect firm value and stuff like that, right? We're looking across firm within country in 4 major emerging markets. In order to do that, we're going to start by having to address an array of methods issues, right? Data limitations are very severe. We have scarce data on governance, especially in time series. And if you don't have time series, I just don't think results are very credible. We often have limited data on control variables. We work very hard to have the most extensive control variables we can. They vary a little bit across country, because we think that if you're going to limit omitted variable bias, one of the main things you can do is not omit the variable. So if we can measure something, we want to have it in our regression estimation. We've got small samples in many countries. There aren't that many public companies. In 2 of the countries, we run our own surveys because otherwise we can't get decent data at all. So then we have sample selection issues. We have this underlying construct validity issue. What we call corporate governance, how does that map onto good corporate governance? How does that vary across countries? If we can deal with all of those, then we can get to endogeneity, which is the first question everybody's otherwise going to have, right? You only get there if you have good data and you address construct validity issues. I do want to argue that the principal risk here is going to be omitted variable bias rather than reverse causation, value causing governance, but both are possible here. Okay, so those are some data issues. I'm going to put aside construct validity. I presented that paper at the last GC conference. It's boring, technical, and important. Even my discussant at the last conference thought it was boring. So I won't talk about it. I'm also going to, we don't have a shock here, right? Natural experiments are great, but they're one country usually at a time, and they're a limited piece of governance. If you want to study overall governance and want to see what generalizes, you're not going to be able to rely on natural experiments in most cases. Hopefully we get some generalization. Okay, prior emerging markets research, 2 main approaches. Let me call it the massively multi-country study, broad and shallow. Shallow in terms of nothing is specific to any particular country. There are a couple of now old indices that study emerging markets. They're not available in time series. There are some papers studying them. Weak research designs, right? Cross-sectional evidence, common index, the same in all countries. I'm going to argue to you that you're not going to get good results out of that. And it's someone else's index. And usually, if you're going to study 40 countries, you end up with 5 covariates because you can't measure covariates across countries. Alternative approach is a narrow, deep country study with a local index tailored to that particular country. There, too, many have only cross-sectional or pooled OLS results. And so if you actually look at what those studies are and say, what do I need for minimum credibility, right, other than a shock or a natural experiment? Well, I want to have panel data. I want to have firm effects, ideally fixed effects, but certainly random effects at a minimum. By now, we know that we have to, if you've got panel data with firms, you better cluster your standard errors on firm. What's the sample of papers that does well? The answer is, I'm sorry, but I'm a co-author of all 3 of them. That's it, right? There's not a whole lot out there. This paper is going to try to take a middle road. We're going to try to do 4 careful country studies in 4 major emerging markets, Brazil, India, Korea, Turkey. And the idea is that we get something that generalizes across those. There's plausible that it would generalize further, but we, of course, don't actually know. That turns out to be a very large data collection effort. That's another boring topic. We're going to try to embrace construct validity concerns by saying, yeah, corporate governance may be a similar concept in all countries, but how you measure it is going to depend on the local country rules. What counts as good governance may depend on local country institutions. And then we're going to try to address omitted variable bias by showing you some confidence bounds, some lower bounds on our firm fixed effects estimates if we assume different levels of omitted variable bias. And so in effect, we're going to use techniques to beat on our own results and say how strong would the omitted variable bias have to be to make the results go away. In a hierarchy of research designs, right, we don't have a randomized trial, but not many people do in finance and accounting. Again, we don't have a shock. We have a bit of a shock in Korea and Turkey, but mostly, look, we've got panel data. We can run panel data with firm fixed effects. We can have lots of covariates the best we can. I still think this is real progress, and we learn something about important questions. So far, referees have not yet agreed with us, but we'll see. Okay, so the prior project results for overall governance, I'm going to show you some of that. It's going to turn out that to build a sensible index, you just can't get the data to build the same index in each country, even if you thought that was the right thing to do. There is evidence that endogeneity matters. Firm fixed effects or random effects estimates can be very different than pooled OLS estimates. Using extensive versus few control variables matters. As you add more control variables, your estimates shrink towards 0, right? So adding those covariates does look like it's doing something to limit omitted variable bias. And I'll show you at least some evidence that our country-specific indices as a whole can predict Tobin's Q, but that if we tried to build the same index in all countries, we couldn't. And then we'll go on to this project. Okay, so what are we going to look at? Does disclosure predict firm value? Does board structure, however we measure it, predict firm value? Board procedures, right? We think it's important if you're going to study one aspect of disclosure, of governance, whether it's disclosure, whether it's board independence, whether it's audit committees, you better control for the rest of governance because governance is correlated with each other. So if you just look at one aspect, you build in omitted variable bias from the rest of governance that you haven't measured. So one strength, I think, is we start with a broad index. We're not just studying disclosure. We're not just studying board independence. We're studying disclosure controlling for everything else about governance, or at least whatever we can measure, or board structure controlling for whatever else we can measure about governance. Okay, overall results, and then I'll actually show you some results in a bit. We find strong evidence that disclosure predicts Tobin's Q. Okay. Board structure, maybe. Some evidence in Korea and Brazil, yes, not so strong in the other countries. Nothing else predicts at all. Whether because it doesn't matter or because we haven't measured it right, we don't know. Within board structure, the evidence is stronger for board independence than for board committees, but with a caveat that what we mean by board independence is very country specific. In Turkey, this is going from 1 independent director to 2. It's not going from 70% to 90% as you would see in the US. We have no opinion as to whether that range, which we don't even observe in the data, would have value. We're looking at variation within the range that one actually observes in these countries. Within disclosure, we find stronger evidence that financial disclosure predicts than that non-financial disclosure predicts. There's some evidence for non-financial disclosure as well. And I think I always end up, or do my results as a whole seem to make sense? And yeah, it makes sense to me that financial disclosure is going to have a stronger effect than non-financial disclosure. Okay, so the advice for firms and maybe countries would be if our results are causal, and I'll show you that that's probable but not certain, there would be payoff in firm value from investing in better disclosure, especially financial disclosure. Maybe, again, within the margin that we observe, there's some payoff to investing in board independence. Okay, so let me go back to the methods issues, governance data. There is no good multi-country index over time. There is the ISS index, but it's very US-centric in the questions that it asks, and it doesn't cover developed countries at all. The time series indices that cover emerging markets right now are Asset 4 and Thomson Reuters. Thomson Reuters bought Asset 4 a few years ago, but they still maintain 2 separate indices. Neither of them predict anything, right? They just don't. They don't even predict anything in cross-section, let alone with firm fixed effects, right? So we can't use somebody else's index, right? This is part of our fun with referees. Well, why didn't you just use this off-the-shelf index? Okay, so the next draft of the paper shows that that wouldn't have been useful. So we build our own index instead. This is a summary of what we're doing. We're still trying to collect additional data. Here's what we try to do to address construct validity-ish concerns. So we're going to build the best country-specific overall index we can. And each index looks at the others for, does this element make sense here or there? But at the end of the day, a lot of this is going to depend on Wuchan's judgment as to what makes sense in Korea, Burchin's judgment as to what makes sense in Turkey, Gledson's judgment as to what makes sense in Brazil, Vikana's judgment as to what makes sense in India. We don't know what's good governance. There's some results in the literature, but they're not very strong. So we're relying on, yeah, we think this is good governance, and I want to be upfront about that, right? And so we're going to have disclosure, board structure, again, disclosure, financial, non-financial, board structure, independence and committees, board's procedure, ownership. How much does the controlling shareholder or family own, and do they own different voting rights than economic rights, shareholder rights, and control of related party transactions as 6 broad areas that we're going to define in each country through specific elements. And if we go with that, it turns out the elements have to be very different. So what do we want in a plausible element in a country? Well, we have to measure it, duh. We have to think it's meaningful in the judgment of the local co-authors, bearing in mind local rules and institutions. We have to think this moves in the direction of good governance, lots of judgment there. There has to be enough variation across firms to make it useful. If everybody does it or nobody does it or 98% do or 2% do, it's not useful, right? You can put it in an index, but it won't matter. Required by law, it can't be in the index. In India, it can because they don't comply with the law, but in the other countries, that turns out not to be a useful strategy, right? And we don't want to make them too similar to another element, right? We're going to have a set of different elements. Then we have to build these into an index. How do we do that? Well, in each area, we just equally weight. Why equally weight? Because we don't know what else to do, right? Neither does anybody else when they're building indices. And we're going to make them similar across countries to the extent we can, and it's going to turn out that the indices are very different. Let me illustrate that so you understand the issue with Brazil. Okay, so we've got these sub-indices, and what we're going to do is sum them up, right? We're going to, we're in effect normalize each of them, and then we're going to sum them up and then normalize again, and so our governance index is going to be a normalized sum of normalized sub-indices. What's in it? Well, let me look at a piece of this, right? There's a very long, detailed table in the paper. So let's look at board structure sub-index, right? The green are the pieces that are public. at the time that we run this survey. A little bit more is public now. Okay, so we didn't run the survey. We just couldn't know very much about Brazil board structure. All right, and it turns out guessing may not help. So there's a paper by Daya Dimitrov McConnell studying the effect of board independence across countries. They guess based on family last name of the members of the board. Their guess in 2002 is there's 57% independent directors in Brazil. We measure it at 23% 2 years later. No, their guesses weren't very good. Second, importance of local institutions. Brazil has an institution known as the fiscal board. It can be permanent in the charter, or it can be near permanent because it can be demanded regularly by minority shareholders. If 10% of them want the fiscal board, you have one. And so we have to come up with a measure of what it means to be near permanent. And the fiscal board does very similar things to what an audit committee does. It reviews the audit. It reports directly to the shareholders. The members are appointed by the shareholders, which ought to increase independence. And it's probably a pretty good functional substitute for the audit committee. And it turns out in Brazil, most firms have one or the other. They don't have both. And many more of them have the fiscal board. So if we had element, do you have an audit committee? That wouldn't tell us very much about Brazil. Instead, our element is, do you have an audit committee or a fiscal board? Very different element. Now let me compare Brazil to Korea, just to take another of our 4 countries, right? And so the green, again, are the two that are public, right? The only available common elements that we can even measure are, do you have 50% outside directors, which is very rare in Brazil, and do you have an audit committee, which is not very useful in Brazil. That's the problem. That's why we're building separate indices in separate countries. Okay, so I talked about construct validity. Covariance, another boring but important topic. We work really hard at developing covariates. And as I said, the results weaken as you strengthen your covariates, which to my mind justifies the effort to develop an extensive set of covariates. Okay, so prior country level results, and I'll show you random effects results and fixed effects results. No guarantee that you'll get similar results, but in fact we do. And so in all 4 countries with our country-specific indices, we get reasonable predictive power for Tobin's Q. Fixed effects are weak in Brazil, but maybe that's mostly the sample size. But the other 3 countries, we still get significance. The other 4 countries, you have Russia for this. We can't use it for the current study at the subindex level. We don't have the data. We can now pool those country-specific results that might be pushing construct validity a step too far. We can then measure whether this pooled index predicts Tobin's Q. We're again going to be serious about covariates. We're going to build a separate response surface in each country. We're not just going to say the covariate is log assets. The covariates is going to be log assets interacted with country dummies. And the same thing for all the other covariates. And again, that turns out to matter. Your coefficients will go up if you don't have the separate response surfaces. Okay, so here's what we get. So the first column is our index, right, and pooled across countries. Looks very good, right? What's the difference between weighted and unweighted? Well, if you want to weight countries equally, you can do this with fixed effects. There's no good way to do it with random effects. The second, what's going on here? So we say, out of the elements in our indices, some of them are common across countries. At least, you know, our standard is, are they common across 3 of the 4 countries? Do the common elements predict anything? No, they're not even close, right? I mean, we get real coefficients for the country-specific elements and absolutely nothing for the common elements. So this is a way of reinforcing, maybe you don't like the strategy of measuring things differently in different countries, but your alternative is to get mush. And then the third is just, instead of common versus non-common, it's common versus our index, which includes the common elements. And now the common elements by themselves all have negative coefficients, even if they're not significant. So again, the common index just isn't doing meaningful work here. Okay, which sub-indices? So on to this project. So the top row is a disclosure. Random effects, fixed effects, random effects, fixed effects across countries, and the last 2 are the pooled sample. And what you're going to see is disclosure predicts across countries, right? And board structure, Brazil, yes, with random effects, gets weaker with fixed effects. Korea, yes, very strongly with both random and fixed effects. And we have a true natural experiment. shock to board structure in Korea, so I believe those results. And then the pooled sample, yeah, maybe, right? I've done enough projects that I do not understand why finance and accounting think that a t-statistic of 2 is acceptable for credibility. Astronomy thinks it's 3. Physics thinks it's 5. It's too easy to make a t-statistic of 2.2 go away by changing your specification. Now, we've beat on our specification already, but still, right? These are some evidence for board structure, not terribly strong, but much stronger evidence for disclosure, both because it's consistent across countries and because when we pool, we actually get t-statistics that are going to be hard to budge. Okay, then we said, disclosure matters, board structure matters, nothing else. Let's put disclosure and board structure together just for fun to see what happens, right? And so DBS is disclosure plus board structure, and then the DBS complement is everything else in our corporate governance indices. And what you're going to see is across countries, again, India is not so much, Turkey is not great, but nevertheless, disclosure and board structure together predict something, and everything else predicts nothing, right? The coefficients are small and not close to significant, right? India being the exception where you don't have good results. Maybe, why not? What's different about India? Well, India turns out to have very strong board independence rules to begin with. Maybe once you're above the minimum, what you do above the minimum doesn't matter. But they have stronger minimums than the other countries, and that might be what's going on there. So anyway. One message is disclosure matters. Another is other than disclosure and maybe board structure, nothing else seems to have predictive value. Maybe because we didn't know how to measure things, but we don't find evidence. Okay, next piece, we're going to dig down into disclosure and board structure. And so we're going to separate the elements into financial and non-financial disclosure in the first 2 rows. And the results weaken when you subdivide, so neither one of them is quite significant in Turkey. But overall, it looks like there's stronger evidence that financial disclosure matters than that non-financial disclosure matters, right? So non-financial is only significant and barely so when we pool across countries. It's not significant in any of the individual countries. Board independence. To the extent we're getting results, in Brazil, they're coming only from board independence. Korea, they're coming from both. So overall, right, we're getting some evidence that board independence matters across countries, but rather weak for, do you have an audit committee? Do you have a compensation committee? Do you have an outside director nominating committee? Stuff like that. Okay, confidence bounds on omitted variable bias. So the only equation I'm going to show you, right, this is the omitted variable bias formula. You can find it in Angrist and Pischke and other places. And the idea is the coefficient on a long regression that includes the omitted variables will equal the coefficient on the short regression that omits them plus the partial effect of the omitted variables u on the outcome times the partial effect of the omitted variable on the included covariance, right? So you get omitted bias if you have an omitted variable that's correlated with both the predictors and the outcome, right? Classic story. We know the power of the observed covariates to predict the outcome and to predict our measure of governance, right? Those are the 2 sources of omitted variable bias. The idea is to assume the omitted variables, which we don't observe, have similar power to the ones we do observe. And we try to observe good ones that we think matter. And I'll show you results from 2 approaches, and you're telling me I have 2 minutes, but okay, I'll go a little long. One from statistics, Hosman, Hansen, Holland, another from economics, Altonji, Elder, Tabor, then extended by Leslie Oster. And so the idea here is, do I have a pointer? I don't think, is this a pointer? So the first column is we're going to imagine there's one omitted variable that predicts our outcome, Q, as strongly as the best predictor in our data set out of our 15 or 20 covariates, right? The second column is we're going to have one omitted covariate that predicts governance as strongly as the strongest predictor in our data set, right? The third is we're going to have 2 omitted covariates, the strong one for the outcome and the strong one for corporate governance, right? So that's already a pretty severe test, right? The fourth column is going to be, what are we worried about with Tobin's Q? We're worried about, okay, we can observe financials, but we don't observe growth. We don't observe intangibles. Yes, we can measure advertising and R&D, and we can measure past growth, but how good are we at observing intangibles? So the fourth is going to be based on the effect of all the observed covariates that predict intangibles. We're going to assume there's an omitted variable or variables that predict just as strongly as those. Finally, the last column is going to, if we had omitted variables that predict as strongly as everything in our data set that we do observe, right? What are we going to get? And so this is the indices as a whole. And what you'll see is the indices as a whole do pretty well, right? They survive across all of these tests. But notice, again, if we weaken the covariates, if you only had a single response surface, which is what everybody else does, right? Covariate, same covariate in all countries, we're going to get bigger coefficients, right? If we throw all omitted variables at it, we'll get a coefficient of 0.08, which is bigger than what our core estimate is with all the separate response surfaces, right? So having these covariates is really matters. Okay, where am I now? Go here. Okay, so that's what we're doing. Now let's do this for combined disclosure and board structure. Okay, we can do it for disclosure alone and board structure alone, and we do that in the paper, but I have only so much time. So what do we get? So in Brazil, basically not much happens. So the first four are different variants of the Hansen-Hosman-Holland approach. The Altonji-Elder-Tabor is similar to all covariates, but the math is a little bit different. Brazil, nothing budges. Basically, the covariates don't predict our results to begin with. Right, so that's why the coefficients don't change much. India wasn't significant by itself to begin with, so adding omitted variable bias doesn't make it significant. Korea looks pretty good. Korea survives across everything. Turkey, less so. I mean, we can beat on our Turkey results. If we beat on them hard enough, our Turkey results can lose significance. But the pooled results across countries are looking pretty strong no matter what we throw at it in the way of an assumed level of omitted variable bias. So not causal, but plausible that it might be causal, I would say. We looked at, is there power of individual elements to predict Tobin's Q? The answer is no. Really no. Well, there's scattered significant coefficients, but the power of disclosure is coming from disclosure as a whole, not disclosing this piece or that piece. The same thing for board structure as a whole. We then asked, okay, does governance predict profitability? We find no consistent evidence that it predicts profitability. And frankly, for disclosure, I don't think you would think that disclosure predicts profitability. If it predicts firm value, it's more likely to be because investors will pay more for the same reported earnings because they trust them more, or because they think insider theft will be less likely. Okay, so that's it, and over to the discussant.
All right, I would like to thank the organizers for allowing me to discuss the paper. This is a very interesting paper. Obviously, a lot of you may be familiar with the basic idea behind the paper. Now, Bernie obviously did a great job of explaining what is and what is not in the paper. And I will tell you a little bit more about what is in the paper and perhaps a little bit more about what is not in the paper and I hope to see. Now, what is in the paper? What is in the paper is corporate governance. A lot of sub-indices, a lot of different items being collected across emerging markets. Now, obviously, this is, in my mind, an example of a successful team, right? Because you have authors from 5 different countries working on 4 different countries. Now, actually, that will form the basis of my first question. So, in summary, I think this is a very important work precisely because we don't have the data. Okay? We need data to be able to say anything about any subject, and we don't have the data. So I think the data is wonderful. The authors have developed a very broad index of what is corporate governance, including these 6 different sub-items, sub-indices, disclosure, board structure, ownership structure, shareholder rights, board procedure, and relative party transactions. It seems like disclosure is important, particularly financial disclosure, for firm value. Now, I think something that's a bit missing in the discussion, I think Bernie tried to say it several times, but when you read the paper, it doesn't come off cleanly, is that the multi-country index does not predict firm value. And this is something that I would like to, I feel that the authors may have given up on this a bit too early. So perhaps we can try to develop a better measure of multi-country index that actually maybe cover disclosure and perhaps do a better job. Okay, like I said, ambitious data collection, ambitious goal. Okay, now that leads me into the question of what can be done more. And I think what is somewhat bothers me that there is no discussion about developed markets. Now I understand that we probably know a lot more about developed markets than we do about developing markets, but I feel for this study to be complete, we need to make some comparison across developed versus developing markets. So for example, the paper says something along the lines of there is significant variation in corporate governance practices both across firms and within firm across time. Sounds like something that is true even in the US, in the UK, right? And I'm just curious as to why we don't do a better job with that even with the developing markets. Now, there are indices that are available publicly that perhaps can be compared to the indices that are in this paper for the emerging markets. Okay. Now, let me talk a bit more about what is in the paper. I'm going to talk about causal link, maybe digging a bit more into financial disclosures. Some attribution analysis, which I think is missing in the paper, but I think is very important. And perhaps we can talk a bit more about building a better multi-country index. Causal link. I am not in the generative list. Let me start with that. But the paper does say something about, we are interested in the causal questions, so I feel like I have to say something about it. Anybody who knows my research know that I have never been able to identify an instrument variable. So even if it's staring me in the face, I will still miss it, right? So I don't blame the authors for not having that. But again, I think this is a very admirable aim, but the paper, again, focus on panel analysis, which I think is very difficult to make causal inference. They try hard, and they actually say something about this is not true causal, and therefore you have to worry about omitted variable and reverse causation. The paper talks a lot about omitted variables, right? A lot of covariance, some lower bound analysis, so a lot of work on omitted variable. The lower bounds test, I'm actually not very familiar with this, so I had to dig deep into what this lower bound tests are actually doing. And my understanding is that the lower bound test actually assumes that there's a missing variable, there's omitted, there's equally good as the best variable that is included in the regression in terms of predicting the dependent variable, right? Now, there's one big assumption here, and this is the big assumption. You can see it. The correlation between the variable of interest and this omitted variable, okay, is equal to the largest value of the correlation between that variable of interest and what is included. Now, is this a reasonable assumption? I think it is. Now, there's another assumption that is made inadvertently when we are doing this, which is that whether or not the new covariate, the missing variable, is actually orthogonal to what is in the regression. And that's the part that I'm sort of a bit nervous about, because this assumption of orthogonality, how orthogonal is orthogonal, right? Is it 0.1, 0.2, 0.3, 0.4, 0.5? What is the appropriate correlation between the omitted variable and the variables that are included in the regression? I think, so I feel that we need to do a better job in terms of perhaps doing some more sensitivity analysis in terms of this second assumption, whether or not how orthogonal are the covariates relative to the variables that are already included in the regression. Now, of course, it's very difficult, right? Because these are omitted variables. They are omitted because most of the time they are unobservable, and therefore, how do you assess the validity of this assumption? I think it's very difficult. But I think I would like to encourage the authors to maybe think a bit about this a bit deeper. Now, having said that, I would say this is a very useful exercise because at least it forced us to think about this issue, right? Now, I would make one suggestion, which is that because I think this is such a useful exercise, that perhaps this should be reported immediately from the very beginning, rather than reporting all these regular t-stats or regular p-values. Perhaps we just go and report these lower bounds immediately from the beginning in the paper, right? Rather than jumping in, like for example, there's a table 11. Forgive me, I don't remember what table 11 is. But the point is that it's used throughout the paper, but it's used sparingly. I think it should be used as the basis of the main, all the inferences in the paper. The second part that I want to talk about is about reverse causality. This is something that the authors are brushing aside relatively quickly because of their previous work. Now, let me tell you the reverse causality here. It should be familiar to a lot of you. High-value firms can afford better governance. And the idea here is that if you are a better firm, if you're running a better firm, then you will be more willing to engage with shareholders. You will be more willing to have independent boards because you're not worried about getting fired. You have a good firm. You're not going to get fired. If you're running a bad firm, then perhaps you're going to try to shy away from having to deal with shareholders. That brings me a problem of whether or not, so which way does this causality go? Is it that governance is driving valuation, or is it valuation is driving this sub-indices of governance? So the authors brush it relatively quickly because they already have done a lot of work in this area. And there's this line from the paper. They basically say, look, time-varying firm characteristics only weakly predict governance. Now, my question for the author is because disclosure is such an important part of presumably predicting valuation. Is this statement above true for disclosure as well? Perhaps you can just look at it again and at least report it for the sample in this paper, because this paper is a little bit different from the previous studies. Then perhaps looking at redoing this analysis for the sample in the paper would be useful for the reader, just to convince us that this is something that's not really a problem. The offered solution is firm fixed effects. Now, I would like to caution against this idea of the firm fixed effects will solve all the problems, because for many of these observations, there are only very few snapshots. So for example, for Korea, there are 3 snapshots. Or for Brazil, there are, I think, 3 snapshots as well. Then the question is, what does firm fixed effects do? You start thinking about this. So there are only few firms that changed in that period, right? You have 3 snapshots. So all the power is coming from firms that actually changed their governance. Okay? So firms that have, let's say, high governance value, have governance scores to begin with, and continue to have high governance scores to begin with, they're basically thrown out from the estimation. Okay? So in my mind, there's a very strong, I think the authors are taking a very strong stance in the sense that, look, time variation is the only thing that matters. Which, when I think cross-section is actually quite important as well. Perhaps you can think about change regression because it goes in the same direction. Now, of course, it has the same problem, right? So something to think about. I'm not sure what is the solution here because I'm a bit nervous with firm fixed effects and only 3 snapshots. Okay. Now, let me dig deeper into disclosure because I think this is an important part of the paper. The accounting profession will be happy, right? Statutory boards will be happy. The academics will be happy. Now you can write more papers about disclosure and the value of disclosure. But do we know enough about disclosure? And my sense is that we do know a lot. The accounting literature is littered with papers about disclosure. I'm writing one, right? There are a lot of potential right-hand side variables that you can put, all the covariates that are probably not what you're used to including in a corporate governance study, but because disclosure is important, they need to be included. Okay, so for example, asset volatility is one. I have a bad paper about investor location and how investor location can actually affect the disclosure policy. If you have investors that are far away, then you disclose more. Okay? So these things may matter for disclosure choice. And I think disclosure is a choice. And I think it's an important variable because there's demand and supply for disclosure. Okay? The demand is coming from, for example, the shareholders or the analysts. So one of the things that the authors are looking at are things like, does the firm have regular meeting with analysts? Well, this only works if the analysts actually ask for meetings, right? If the analysts don't care about the firm, then there's no disclosure to be had for this particular item in the index. So it's a demand and supply variable. There's a demand for disclosure and a supply of disclosure. English language financial statements exist. Well, if there's no demand for English language, we don't see it. So to some extent, I think this disclosure policy is related to many things. One of them is product market competition. Okay? Another one would be regulatory requirements. Now, I think product market competition is very important here and something that the authors, I think, should take more carefully in terms of thinking about covariance that matter for disclosure policy. Because this product market competition, I think, affects both disclosure choice as well as firm valuation. If you live in a competitive industry, then you worry a lot about disclosing too much to your rivals through the analyst. Okay? So something to think about. Because in my mind, there's a lot of covariance that you need to include if you're going to say disclosure is important. Well, we have to worry about all these other covariance that may not matter for things like board structure. Okay? So the way I would like to see probably a better link from disclosure to firm value is looking at the channels. So there are two channels that I can think of. One, these are channels that are actually identified in the paper. So the authors talk about improved disclosure to reduce information asymmetry. Now, in my mind, that means that maybe volatility will be lower in the stock market, and that's something that the authors can check. The second channel is whether or not it affects liquidity. Because if indeed disclosure allows higher liquidity and higher firm value, then you can directly test these channels, right? So perhaps it will be more convincing to me, at least, if the authors actually look at these potential channels through which disclosure affects firm value. The last point I want to make is about attribution analysis. Sorry, I won't get to the multi-country index. The attribution analysis. So the R-squared is high in these regressions. Sometimes 0.5, most of the times about 0.4, so the R-squares are high. Part of it is because, as the authors say, they have a lot of covariance, right? They have a lot of control variables in the regressions. So of course, the R-squares are high. So, and also the firm fixed effects, I think, makes a difference. So now the question I have is, what is the marginal R-square of the governance indices? How much of this 0.4 is coming from the governance indices? Okay? And more precisely, I'm sort of interested in the R-square, the between R-square, so between firms, right? The cross-sectional variation, as well as in the time series. So I think it would be nice to see the attribution of how the 0.4 R-square is achieved, and how much is coming from the governance indices, and how much is coming from the time series versus the cross-sectional. I think having some discussion about the power of these indices of explaining firm valuation, I think is quite important. And I would like to see a bit more of this attribution analysis. Okay? So country level variation, industry level variation, firm level variation, how much of these are coming? So I think this is very useful for us to understand a bit more about the importance of these governance indices. Because if the marginal R-square is 0.1, then I think it is important. If the marginal R-square is 0.02, then I'm a bit nervous about how important this is, right? Because the T-stat doesn't tell you everything, as Bernie obviously said earlier. Okay? So multi-country index, I'll touch on this very briefly. I feel that I would like to see a multi-country disclosure index, because I think if disclosure is important, then there are aspects of it that are common across countries, then perhaps I want to see this a bit more. But the problem is that there's a lot of these NMs. What is NM? Non-meaningful. Non-meaningful means that in the context of this paper, that there's no variation across firms. Presumably because it is required by the law that this disclosure is made. Okay? So there's a lot of NMs everywhere. And then becomes a problem. Now, my solution to this problem is perhaps what we want to see is something similar to like credit rating analysis when you think about sovereign rating versus the firm level, right? So separating between the country risk and the firm risk. So perhaps it can be done in the context of this paper as well, when you have a sort of a country index, a cross-country index. So each country A has a higher governance rating than country B. And then within each of those countries, you have variation across firms. Okay? So something along the lines of maybe generating a country level index where you have poor governance, where you have all these NAs. Okay? Also maybe looking at the percent of responders to your survey, because if you look at Korea, the survey, you get 90% responding. If you do it in India, you get less than 10% responding, which to me tells me something about the importance of governance that are being placed by these firms. And to me, this seems like a relatively poor governance. Okay? So that's it. In conclusion, I think the paper does many things well, but in my mind has not yet achieved its very ambitious goal, the goal that the authors set for themselves. Thank you.
Thank you. You said you gave equal weights, and you didn't have a reason for that. I was wondering if you considered doing some factor analysis so the data would give you weights for this?
You tried using principal component analysis in a construct validity paper. It didn't come out a lot different than just using our indices. We could revisit that, but I'm a little bit worried about, I felt better about saying, let me build the index first and then test it, rather than try to then...
there could be complementarities and substitutions, and you just put equal weights, and factor analysis would also... I was thinking there could be complementarities for factors and not just, or substitutes, right? And factor analysis or principal components will give you that, which equal weights don't.
Very ambitious paper, Bernie. There's a couple things that, with this kind of data, that I'm a little worried about. One is that you may have a number of very closely held firms where the controlling shareholder has effectively 50% of the votes. That gets amplified in a lot of these countries because you've got business groups that when you combine all of the holdings of each of the individual companies, again, you can have a controlling shareholder with 50% or more of the votes. In those cases, I would think the boards are going to be a lot less effective. And so I would think it would make sense to try and control for what subset of the firms are in those categories. I'm also worried about one other major issue, which is in small economies, I see it in Australia, what you often see is that the independent directors may be officially independent, but they have long-standing relationships with the officers of the company. And I think that's something to at least be worried about when we're trying to generalize these results. And then finally, I guess it would be, interesting to try and control for any companies that were cross-listed on, say, in the US or the UK or some other more demanding disclosure environment.
Okay, so thank you. So we've got a business group dummy in the regressions. We've got an ADR dummy in the regressions. We've actually two of them for different levels of ADR. You can always go further, right? There's an issue also of sample size in some of the countries. Most of these firms have a controlling shareholder or controlling shareholder group it's certainly true in Brazil. It's certainly true in Turkey. It's less true in Korea. That's true of many of the biggest firms, but not throughout. But no, there's lots of control. Controlled, control is the norm, right? Business group is not necessarily the norm. I'm not sure how much more we can push on that. I think an interesting question that I'm trying to explore, not very successfully so far in Turkey, is, look, if you've got a firm within a business group, does firm-level governance matter as opposed to business group governance? The issue is, how do you measure business group governance? So I'm sensitive to the importance of business groups. I don't have a good answer for that one. I'm sorry, you had another piece of your question that I forgot.
The last point was that you may have independent directors.
Oh, yeah. So
but,
look, we don't know. That was what everybody said in Korea about the Korea reforms that required independent directors. They won't really be independent. It looks like adding independent directors in Korea mattered in an area where I think I have a strong causal design. Maybe they're independent for some things and not others. But it's very hard to untangle those.
I think one category that might be particularly interesting might be either foreign independent directors or blockholder independent directors where the blockholder is not part of the controlling group.
There aren't enough of them, and there aren't enough of them to study, frankly. It's pretty rare, except in the very biggest firms. So we tried looking at, do you have a foreign director as part of our board structure index, and just couldn't do much with it. Yeah, Lan.
Build on to this, just have a suggestion, because I also got the same question whether you really have independence board or not. Maybe don't use the term independence. Just use the term outside directors.
Yeah, that's what we do. Yeah.
Yeah.
Because the difference between the two is hard to distinguish, right? Some countries require, quote, independent directors. Some just require outside directors. For this purpose, I want to think of those as indistinguishable concepts at the level of what we can measure.
Yeah, just to add on a little bit, I think because in Asia, the way we adopt these corporate governance, right, we just copy the name. But in reality, it's the families who control everything. We can invite outside, it can be outside because that's what the stock exchange want them to do. So they comply with these rules. But it doesn't mean that, the board members can ask any difficult questions. If you do so, next time I'm not going to appoint you no longer.
There may still be some disciplinary value for related party transactions, right? Okay, so I say no to a transaction. They don't invite me back, but I may still say no.
But maybe it's worth it to have outside directors for the networking, for the reputation, for the information, not just for the monitoring effect.
Maybe. That's just way too granular for us to get a handle on, is what role is a director actually doing. So I'm always sensitive to, okay, there are questions that our data can't answer. Yeah.
Okay, thanks. So Bernie, I think the point about governance is different in different countries is pretty valuable, or it's very valuable. But I was wondering if you could do more. I mean, because you mentioned the aspect 4. I mean, I think systematically showing what are the dimensions along which these standardized indices sort of fail might be useful. I mean, not even just forget about the correlation with Q, right? I mean, that's like a can of worms, right?
Yeah.
But just sort of showing in the paper that, okay, here's what aspect 4 says, here's what our data says, and this is why these measures are not useful. I think that would be really valuable if you could emphasize that.
Okay, we can. It turns out that neither Asset 4 nor Thomson Reuters has said anything about disclosure. It's just not part of their index. Maybe that's why the indexes don't predict anything. So we can say that more loudly in the paper, but...
Yeah, I'm following to the previous comment, and I wonder whether expected Q is what we are interested in when we look at governance. Because, for instance, independent directors, they do not share in the upside of shareholders, so I would expect their role to be especially important in addressing downside risk, so default probabilities, these kinds of issues. So, and even other aspects of governance, are they really targeted to maximize value to targeted at the expected value rather than the left tail of value?
So I agree. This is where limited sample size is going to come into play. So if I've got a sample of, 100 firms or less than 100 firms, and I start to look for effects on one tail, we're never going to get anything. You need a big enough sample so that you can get statistical power, even though you're focusing on extreme outcomes. So I wouldn't be optimistic that the effort would lead to anything, even if there was an effect there. just because of statistical power issues. That's a challenge in working. I mean, these are relatively big emerging markets, but still the sample size is limited.
But what about defaults? Disappearing firms. What about defaults? Disappearing firms. 100 companies stay for all the sample period, but how many of the ones you would have selected at the beginning survive in the end?
You know, we could look at disappearance from the sample. That would be relatively easy to do. Easy enough to do. I'm responding to, not can we do it, but would I expect to get anything meaningful out of it?
Bernie, I'm curious how exactly you think about what matters for corporate governance, because there's very different ways that I think I've been hearing you talk about this. One is you could say, well, these societies are just different. And in some society, everybody, let's take an extreme example, everybody's super honest, so nothing matters. In another society, everybody is a crook unless they are checked by independent directors, so there it really matters. That's one vision of this difference and what matters. A very different vision I hear you say when you say, oh, this thing is the same in every firm in this country, but because it's mandated by law. That's a measurement, and that's sort of, if the task is predicting within country dispersion of outcomes, that's correct. But if we are wondering about what creates value, then I wouldn't drop it just because every firm has it, because it would still be a causal factor in pushing up Qs, or in a cross-country study, that would still be an important thing to have. If you were interested in predicting within country dispersion, for example, for advising a fund manager or something, then also maybe data mining would be a good thing if you do it right. I mean, not data mining in the bad sense that you are p-hacking, but data mining in the sense of actually trying to learn from the data in the best way you can, rather than testing a preformed hypothesis.
So I don't want to underestimate the amount of work it took to get time series data in 4 countries, okay? In order to get anything out of country variation, you need a lot of countries, right? That's a very different project. And unless the World Bank wants to throw $5 million at me to do it, I just don't have the bandwidth. We don't have the bandwidth. Every extra country is very large amount of work. Getting from 4 to 5 still isn't going to get us at country level governance. For that, you're going to have to start with the country level rules, and it's going to be a very different project. But I don't think it's going to be easy to blend the two, just from a data perspective.
Sorry.
No, this guy's I'm sorry, you've had your hand up for a while.
Yeah, just a narrow point on the India explanation. If I understood you correctly, you said that the mandatory legal requirement on independent directors was high, and therefore that was a plausible explanation for not finding the statistically significant results there. But I find that explanation a bit hard to maybe accept when you're comparing it with Korea, because arguably Korea's, at least for the larger listed companies, has a higher mandatory requirement requiring a majority, as opposed to India requiring 1/3 or 1/2, depending on if your CEO and director are separate. And so
our data period captures the increase to a majority in the larger Korean firms. The smaller firms have a much weaker requirement. So on the whole, India, the requirement is in place throughout the whole time period. Korea, we capture the time variation. That's the difference.
Okay. And then I guess the second point, and this was, I guess, brought up a bit by the discussant, is I'm just curious to get your thoughts, why you're limiting this to emerging markets, and especially throwing Korea into the mix. Korea is, if you look at...
Maybe it's emerged by now, yeah. But
Yeah, you're looking at capitalization, you're looking at whether it's GDP per person, health, education, everything.
Yeah.
It's so far different from India, Brazil, and Turkey. Then are you saying that Southern Europe is also emerging, right? Like,
Probably. Yeah. Or at least in Europe,
well,
for
you
sure.
would have to if you're going
Eastern
to throw
Europe,
that
for
into the
sure,
mix.
yeah.
So it's just why would you include Korea into the mix if you're emerging? And then the second thing is, why limit this to emerging?
So again, this is an issue of unless somebody wants to throw $5 million at me, I just can't go grab a whole bunch of developed countries and try to do the same thing there. It's a wonderful idea, but we can't do it. Right? I don't have a better answer than that. Right? It's not entirely satisfying, but it's the real limitation of what an individual research team can do in terms of getting firm-level data and coding the firm-level data at a really granular level, right? We can't do it, right? It would be interesting to ask the question, but I don't have the ability to ask the question, even though it would be interesting to see, okay, within a group of developed countries, do the same things predict? We would have better ability to measure in developed countries. So in that sense, we'd have better ability to say what the same factors predict. But we can't do it in this project. So that was going to be part of my reaction to the very interesting discussants. Or there are things that, yeah, in an ideal world, I might want to do this, but in this world, in one project, right, there's a limit to what one project can plausibly do, and I think we have to stay within the countries we've got, right? And we could try to add conceivably one or two more, but that would, delay the project for 3 years. And so it's just not clear that the payoff is enough. I mean, that's the middle road we chose, is to have 4 countries instead of 1, but 4 countries instead of 25.
Because of time. Want to ask a lot of questions? Jeff, do you still want to ask a lot of questions?
Yeah, I do. I mean, because this, I want to pull together a few points made. So you've chosen Tobin's Q, which looks at an output, as opposed to ROA, which looks at kind of a change in the performance of the firm. And so the point as to whether disclosure matters because behavior will change, or because investors are better able to appreciate the behavior that already exists, that's really the point, Spauman raises here, right? As to whether does governance, I mean, in focusing on Q and disclosure, you aren't able to distinguish between a governance change that will improve the way the firm is run, the way real behavior will change, versus the ability of investors to appreciate what, in fact, the firm is doing.
So I said this in the talk, but quickly, we say it in the paper, we do not find a predictive effect on profitability. We look, we don't find it. And for disclosure, I think it's plausible that we don't find it, but we look and we don't find it.